costs. When they're selling little, they have low costs. So their costs are going to look like this. Firm V is going to have fixed costs. So no matter what's going on in revenues, we're always going to see that, let's say, the costs look like this. Right? That's a fully fixed cost. It doesn't change. Now, what's going on with profits? Firm A, the profits are pretty much constant, right? At any given point, this is the difference, right, between revenues and costs. So it's actually not really dependent on how much revenues are coming into firm A, right? And if it's not dependent on revenues, then it really isn't very affected by the market. Who cares if there's a recession or not? Their profits are going to be about the same. Let's look at firm B. Firm B is very dependent on what's going on in revenues. In a bad time, like right here, sorry about that. Well, I think I just lost that, but in firm B, like we just saw, we saw the revenues are kind of all over the place, but the costs, right, don't change. So in a bad period, like right here, you're losing a lot of money, right? Because this is all loss. In a good period, you're making a lot of money, right? That's all your gains. Then you have another bad period and you're losing a bunch of money again. So what this is saying is that you're really dependent on your revenues. And if you're dependent on your revenues, you're really dependent on the market. Because recessions are going to really hurt you and booms are going to really help you. So going back to this argument about operating leverage, what we're seeing is that firms that have high fixed costs are going to have high betas. Now, one way to estimate fixed costs is just going to be fixed cost over variable costs. But to be honest, this is actually sometimes difficult to estimate. So we're going to use an alternative measure, which is going to be kind of related to the argument we just made. We're going to be looking at the EBIT variability measure. EBIT variability is going to be the percentage change in EBIT over the percentage change in revenues. So for a 1% change in revenues, how much are you seeing in a change in EBIT? Now, if you're a company that has a lot of variable costs, what that means is as your revenues change, your costs are also going to change, right? So a change in revenues is going to not have much of an effect on the change in EBIT. So your EBIT variability measure is going to be fairly low. Alternatively, if you have a company with a lot of fixed costs, there's going to be a large change in EBIT because the costs, which are fixed, right, aren't changing. So what this is telling us then is kind of the same thing as this measure above, right? It's giving us a measure of what percentage of your costs are fixed. It's just a more indirect measure. What's nice about it is it's based on very easy to measure things, EBIT and revenues, which we'll always be able to see in companies. So, looking at Disney's operating leverage from 1987 to 2013, we're going to take all of the net sales right here, and we're going to estimate then the percentage change in sales from one year to the next. We'll do the same thing with EBIT. We're going to take EBIT, and we'll estimate the percentage change in EBIT. Now, based on this information, what do we see? We find that the operating leverage during the entire period was 1.0, 1, or 1.25, from the more recent period of 1996 to 2013. So, in general, I find Disney's operating leverage is either 1.25 or 1.01. If I compare this to average entertainment companies, which have a 1.35 operating leverage, do we expect Disney to have a higher or lower beta than other entertainment companies? We expect that they have a lower, right? Because they have a lower operating leverage than other entertainment companies. The third determinant, which is going to be the most important for our class, is financial leverage. Now, financial leverage is just another type of leverage, like operating leverage, right? And a way to understand that is that when firms borrow, they create fixed costs. Now, in financial leverage, the fixed costs are interest payments. If you take a lot of debt, right, you have to pay it back each month. And so you're creating large fixed costs for each period. And that's going to make earnings more volatile. Right? And so we saw a couple slides ago that what that means is, again, you're going to be really dependent on what's going on in revenues and therefore what's going on in the market. Another way to think about this is that this is giving a lot of risk to equity investors, right? Because you're creating earnings that are very volatile. Because of this increased earnings volatility, we're going to see an increased beta. Now, a really important equation that we're going to use in this class is the relationship between a levered beta and an unlevered beta. And what we're thinking about here is that if I know what the beta is when Disney doesn't have any debt, that would be an unlevered beta, then I can what's called lever up the beta using this information here to figure out what is the levered beta. So for instance, if I know that Disney has a beta of, let's say, 1.1 when there's no debt, I can use this information to figure out what will the beta be when the debt-to-equity ratio is 10% or 20%. Because the only things I need to know are the debt-to-equity ratio and the marginal tax rate. Now earlier we estimated the beta for Disney from a regression. We said, was that beta a levered or an unlevered beta? The answer is that was a levered beta. Because a levered beta is a beta that actually, for a company that has some debt. Because Disney has some debt, it is levered. An unlevered beta is only possible when the firm has no debt at all. So let's see how we use this in practice. The regression beta we estimated for Disney was 1.25. That's a levered beta because it's based on stock prices which reflect the actual leverage of the company. What was the average debt during that period? The debt-to-equity ratio during that period was 19.44%. Third, the marginal tax rate was 36.1%. If we use this information and we move back to this equation, what we're going to do is we're going to first estimate what is the unlevered beta. So we're going to just take this information right here and move it right to this side of the equation. So we're going to estimate the unlevered beta as the current beta divided by 1 plus 1 minus the tax rate times the debt-to-equity ratio. We'll take 1.25 as the current beta, 361 as the tax rate, 0.1944 as the debt-to-equity ratio, and we're left with an unlevered beta of 1.1. And that we again see here. This is telling us that if the debt-to-equity ratio is 0, the levered beta is 1.1. Now, in each period here, we're going to look at different debt-to-equity ratios that are possible. Debt-to-equity ratio of 11, of 25, etc. And in each of these periods, we can use the same equation to estimate the beta. And what we'll see is that as you increase the debt-to-equity ratio, the beta is increasing, which is the argument we made, right? It's going to be a highly levered company. Leverage is going to increase the beta. That's exactly what we're seeing. Now, the other thing we should point out is that as you increase and you get fairly high levels, like down here, you're getting fairly large betas as well. So this is a beta of 2.18, 2.77, 3.95, 7.5. Those are incredibly high betas. And what's going on is that you're exposing the equity investors to so much risk, you have to compensate them for all that additional risk, and that's very costly when you actually estimate the cost of equity from a beta that's 4 or 7.5. Now, this is a really important point. This is going to be essentially one of the main findings in this class, which is when we think about weighted average cost of capital, in general, debt is usually cheaper than equity. So it seems like if you were a company, you would just take more debt. The problem is that when you take more debt, you're also driving up the cost of equity through the beta. And so these things are going to have to are going to have to both cancel out. We're going to figure out what is the best cost to capital, which means the lowest. And we're going to figure that out by changing the debt to equity ratio so that we get enough of debt that we're benefiting from the low cost of debt while not driving up the beta too much. Hopefully that makes sense, but if it doesn't, we'll be spending a lot more time thinking about this, especially the last month of class. Alright, so here's 2 questions. Again, I would say take a pause at this point, try each one. The first question is making sure you understand the argument between fixed and variable costs. The second question is making sure you understand how to estimate levered and unlevered betas. The trick for the second question is that it's actually 2 steps. You need to estimate the unlevered beta, and then you need to re-estimate the new beta at a different leverage. So pause here. Alright, so the first question, a company is considering outsourcing its personal services. By doing so, it will replace the fixed cost of having a human resources department with an hourly fee that it will be paying a vendor who will provide the services. Now, if you notice, initially we have a fixed cost. Now we have a human resources that will work on a variable fee, right? An hourly fee. So we're decreasing our fixed costs and we're increasing our variable costs. Based on what we made the argument from the second fundamental point, fixed costs drive up betas, right? So if we're reducing the fixed cost, we're going to have a lower beta than we would before. And that's what we find. We'll decrease the beta. Outsourcing the cost will reduce the fixed cost of the firm, and by doing so, we'll reduce the exposure of earnings to types of risk. Right. So moving to the second question. This is one, like I said, is a little bit tricky. Gapla Software is a steel company with 100 million shares trading at $25 per share. That gives us first the amount of equity, right? $25 times 100 million, and 500 million in debt. So that's how much debt we have. You run a regression of the firm's stock returns against a market index using the last 5 years of data, and have estimated a beta of 1.06. If the regression is right, the average debt to equity ratio for the company over the last 5 years was 10%. So this is actually a different rate, right? These rates of 100 million shares times $25 and 500 million are new. The 10% was the old during the period that you ran the regression. The marginal tax rate is 40%. We need to estimate the beta for the current financial leverage. Like I said, this is a 2-step process. The first step was to unlever the beta. So we're going to take what is the beta from the regression, 1.06, and we're to divide by 1 plus 1 minus 0.4, the tax rate, multiplied by 0.1, which was the debt to equity ratio during the regression period. And that's going to give us the unlevered beta of 1.00. So that's the beta if the firm is completely unlevered, right? If there's no debt whatsoever. Now we can use that to re-lever up based on the debt to equity ratio today. So we're going to take the unlevered beta, we're going to take the same tax rate of 40%, and we're going to take finally the debt to equity ratio. And that was the $500 or $500 million in debt multiplied by the 2,500 million or 2.5 billion based on the $25 per share multiplied by the 100 million shares. And if we take that information together, we can re-lever up and find a re-levered beta at 1.12. Now, it shouldn't be surprising that the beta went up, right? Because we increased the debt. The debt was initially 10%, and it went up to 500 over 2,500, or 20%. If we increase the debt, we're increasing financial leverage. That'll result in a levered beta that's higher. So at this point, hopefully these make sense. In particular, this last part, looking at levered betas, is really important for the next lesson on Monday, but also for much of what we're doing for the remainder of this class, especially the third big topic of this class in the last month. So make sure you really understand how to lever and unlever betas. We'll do some more of these in practice on Monday, but for now, make sure everything in this lecture made sense. With that, I will see you in a couple days.